Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So previous 2-3 videos have completed the topic of financial statement analysis. So presently the subject financial decision making, this subject is going on. In this subject, the first chapter, financial statement analysis. In the last videos, I have explained you about the meaning of the term financial statements. What are the uses of these financial statements? What are the techniques of analyzing the financial statements? Number of techniques are there. Among the techniques, first 3 techniques we have discussed, we have done the problems on comparative statement, common size statement and trend analysis. Now ratio analysis is also one of the technique of analyzing the financial statements. But this ratio analysis is very important technique compared to other techniques. This ratio analysis technique is widely used for analyzing and interpreting the financial information. So in this video, I'm going to explain you about the meaning of the term ratio analysis, what are the uses of ratio analysis, then what is the importance and advantages of ratio analysis, limitations of ratio analysis, and classification of ratios. These are the things I'm going to explain you in this video. So watch the video till the end because this video is very important. Without understanding the concept, we should never go to the problems. All the problems are based on the theory which I'm explaining now. So watch till the end. So before further discussion, take a screenshot of the points which I have written on the board. Then I'll explain all the points regarding ratio analysis. Now, first of all, we'll discuss about the meaning of the term ratio. Ratio is a mathematical expression or mathematical technique which makes a relationship between 2 or more variables. So this ratio is nothing but the mathematical technique which makes the relationship between 2 or more than 2 variables. So this technique is widely used for making the relationship of variables in the financial statements. So here ratio is a mathematical expression. It's a mathematical technique to express the relationship between variables. This is a very widely used technique of analyzing and interpreting the financial statements. That is the meaning of the term ratio analysis. Now uses of ratio analysis. Why this ratio analysis will be used? The most important ratio analysis will be used for comparison purpose. So for what comparison you are making? Comparison of the firm with its own performance in the past. A single firm is there. It wants to compare the past performance with the present performance. Past performance with the present performance to find out whether the current performance is better than the past one or whether the present performance is deteriorated compared to the past. This is called intra-firm comparison. Comparison within the same firm, one year with another year. For making this intra-firm comparison, ratio analysis are widely used. Second one, comparison of one firm with another firm. This is called inter-firm comparison. One company will compare its own performance with another competitor, another company, to find out whether our company is performing better than our competitor or not. Ratio analysis are widely used. This is called inter-firm comparison. Secondly, comparison of one firm with the industry as a whole. Industry means a group of companies producing homogeneous goods, same or similar goods. That is called industry. So a company will compare its own performance with the industry as a whole. Example, sugar industry. So many sugar mills are there. So all the sugar mills combined together constitute sugar industry. Now a company, particular company in sugar industry, they want to compare its own performance with the industry average. Again, ratios will be used. Ratios we have to calculate for the industry and ratio we have to calculate for the company. Make a comparison. Next one is comparison of one product with another product. Nowadays, the companies are dealing in multiple products. So different products have different profitabilities. Now the company wants to compare one product performance with another product performance. So ratios will be used. Similarly, comparison of one department with another department. Suppose if there are multiple departments, we can compare the performance of one department with another department. So these are some of the uses of ratio analysis. Then objectives. Why this ratio analysis will be used? The first objective is simplicity. Simplicity. Ratios are very simple to understand. For example, if figures are given, for example, a company earned a gross profit of 3 lakh when the sales are 10 lakh. If we say like that, sales are 10 lakh and gross profit is 3 lakh, it will be a little bit complicated to understand. Simply if we say the gross profit is 30% of sales, so we can understand. That means for every 100 rupees of sales, we are earning 30 rupees of gross profit. The ratios will make the data easily understandable, easily simple. That is the first, objective. Second, establish the relationship. There are many variables which are related with another. So we can make some relationship. Example, the profit is related with sales. Normally, higher the sales, higher will be the profit. Lower the sales, lower will be the profit. So there is relationship between profit and sales. So by using ratios, we can be able to find out what is the relationship. Similarly, current assets are related with current liability. Like this, so many relationships we can create in financial statements. Next one, facilitates comparison. By calculating the ratios, we can be able to make the comparison of the same firm from one year to another year or between different firms. Like that, so many comparisons we can make by using this ratio analysis. That is also objective. Next one, interrelationship. There are certain items in the financial statements which are related, which are interrelationship is there. Example, current liabilities, current assets. So current liabilities will be paid from current assets only. So there should be some relationship between current assets and current liabilities. Next one, planning and forecasting. Ratios are widely used for planning and forecasting by the management. Management has to forecast about the future. The forecasting can be made easy by studying the past. By studying the past data, by calculating the past ratios, we can be able to predict about the future. Then effective tool of control. Some standards are fixed. Now we have to see whether we are accomplishing according to standard or not. If we are not going according to standard, we have to take some corrective steps. So for controlling purpose, again, ratio analysis are widely used. Next, intra-firm and inter-firm comparison. Inter-firm means comparison between two or more firms. Different firms' performance we are comparing, that is called inter-firm. Intra-firm means within the same firm. One year with another year. For both comparisons, ratios are widely used. Next, last one is aid in decision making. Help in decision making. See here, the main function of the management is to take the decisions. And decisions can be taken with the help of information. And this ratio analysis will generate lots of information. By using that information generated by ratio analysis, the management can be able to take the decision. So this ratio analysis will help in decision making. That is aid to decision making. In this way, these are the objectives why we apply ratio analysis. Now, what is the importance or advantages from ratios? What are the benefits from ratios? The first one is study of financial statements. See here, preparing the financial statements is not the end of the matter. After making the financial statements, we have to analyze. Every year, the business will prepare the income statement, that is profit and loss statement, statement of profit or loss, and statement of financial position, that is balance sheet. The profit and loss account, balance sheet, these are called the financial statements. Only making financial statements will not be the end. After making financial statements, it has to be analyzed, dissected, and extracted. Information should be extracted. So this ratio analysis will generate some more information from the financial statement which are already prepared. So importance, advantages, we can generate lot of information from financial statements by ratio analysis. Calculating efficiency of the company. By calculating the ratios, we can be able to measure whether efficiency of the business has increased or not. So it's a measure of efficiency. Ratio analysis is a measure of efficiency. Third one, planning and forecasting. See here, for planning, we need the information about the past. Naturally, past will not be repeated in the future, but by using the past data, we can easily estimate about the future. That is planning and forecasting, estimating. Management's first function is planning. So this ratio analysis will help the management in planning their activities. Next one is support in corrective action. If something goes wrong, then management has to correct it. So these weaknesses, something going wrong, this will be disclosed by calculating ratio analysis. So ratio analysis will disclose where the weakness is, where the problem is created, so that management can take some corrective action. Next one, comparison with competitors. Nowadays, one of the main activity of the business is to compare. Without comparing our own performance with the competitors, we cannot be able to know what are the strength and weakness of our business. So our business strength and weakness we can know only by comparing our performance with the competitors. And this is, possible by calculating the ratios. Next one, reliable source of communication. See here, a business has to communicate with number of parties. Example, the business has to communicate with the bankers, communicate with the suppliers, communicate with customers. So all this communication can become easier by calculating the ratios. Next one, liquidity of the firm. Liquidity means ability of the business to pay the liabilities on time. Whether the business is in a position to pay the liabilities on time, that is called liquidity. By calculating the ratio, easily we can judge what is the liquidity position of the business. Simple example, banker. Before advancing the loan to the business, the banker will find out the liquidity. The banker wants to find out whether business can be able to pay the loan along with interest or not. Then next one is help in decision making. Just now I told you the management has to take the decisions, and decisions can be taken with the help of information, and ratio analysis will generate the information and provide it to the management so that it will be helpful to the management for taking the decisions. That's all. This shows the importance or advantages of ratio analysis. But remember, ratios does not have only advantages, it has its own limitations also. What are the limitations of ratios? This question will be frequently asked in examination. Explain the importance of ratio analysis and what are the limitations of ratio analysis, or what are the objectives of using this ratio analysis. So whatever discussion we are doing now, this will be very much helpful to you in writing the theory question. Next, limitation. What is the first limitation? Wrong conclusion. See here, ratios are supplementary. Ratios are supplementary to the original data. We should not think that ratio is a substitute of actual data. Actual data is primary, ratio analysis is the secondary. So we should not depend only on ratios. Only on ratios. Simple example, if two institutes are there, both institutes have given the advertisement, A institute and B institute. They says that our results are 100%. A institute says our results are 100%, and B institute says our results are 99%. So if we go only by percentages, we think that A institute is better because it gives the result 100%, whereas B institute has given 99%. So A is better, but your calculation is wrong. Your conclusion is wrong. Now you want to see how many students they have given the training. A institute has given the training only to one student and he passed 100% result. B institute has given the training to 1000 students. Out of 1000, 990 students passed. Only 10 students failed. So if you consider the actual data along with ratios, your conclusion will be correct. You should not ignore the actual data. That means we should not depend only on ratios. Along with ratios, we should use the actual data also. We should not exclude the actual data. First, then as dependable as base data, ratios are calculated from the financial statements. So before calculating the ratios, you should make the correct financial statements. If financial statements are window dressed, then definitely the ratios calculated will also go wrong. That's why one word is there, GIGO. In computer terminology, one word is there, GIGO. Garbage in, garbage out. So whatever you give to the computer, the same thing you will get it back. Similarly, if you make the wrong financial statements and if you calculate the ratios will also be wrong. So before calculating the ratios, you must make the correct financial statements. Then lack of consistency. There is no consistency because different ratios are calculated by different methods. Different author says different methods of calculating the ratios. There is no consistency. That is the one of the drawback, limitation of ratio analysis. Next one is impact of price changes. See here, the value of money is declining. How we can say the value of money is decreasing? Inflation. Due to inflation, the prices of goods and services are increasing. Inflation. That means the value of money is decreasing. This is called price level changes. And it's a global phenomenon. Throughout the world, in every country, inflation is there. Value of money is declining. In that case, everything is measured in terms of money. But money itself is not stable. The purchasing power of the money is not stable. And that fact we are ignoring. Simply we are calculating the ratios on the basis of values which are given in the currency. And the currency is not stable. That means the ratios calculated are not dependable, not reliable. Next one is lack of standardization. There is no standard ratio that this should be the standard. That means a company which every company will give the different standard. For example, the standard current ratio is 2:1. But some companies are there where if it is more than 2:1 also, the liquidity position is bad. In some companies it is less than 2:1, but still liquidity position may be good. That means there is no standard ratios to which we can be able to compare. Next one, qualitative factors are ignored. In ratio analysis, only quantitative figures will be taken. Whatever qualitative information is there, that will not be taken into account in ratio analysis. That is one of the limitations. Next one is not ideal for inter-firm comparison. Ratio analysis is not suitable for inter-firm comparison because the method of accounting may be different. For example, one company is following straight line of depreciation. Another company is following reducing balance method of depreciation. When the method of depreciation is different, then financial statements will be different. We cannot be able to compare the performance of one company with another company because both the companies are following different methods of accounting. That is also one of the limitations. Last one, historical data. The ratio analysis will be calculated from the financial statement which are historically made, already happened in the past. That historical data we are using. But do you think that the history will repeat again in the future? It is not sure. It's not, exactly the history will repeat in the future. So whatever we are calculating the ratio, that is only for the past. The future, the completely uncertain future is there. So these are the limitations of ratio analysis. Now, classification and computation of ratios. The ratios are classified on different bases. First of all, traditional classification. According to traditional classification, ratios can be calculated either from profit and loss statement, or from balance sheet, or from both. So some ratios are calculated only the data from profit and loss statement. Some ratios can be calculated only from the balance sheet, and some ratios can be calculated by taking the information from both. In this way, profit and loss statement ratios, balance sheet ratios, and mixed ratios. This is the traditional method of classifying the ratios. Secondly, functional classification. According to functional classification, the ratios will be classified according to one characteristic, according to liquidity, according to profitability, according to solvency, according to activity. Like this, we classify according to functions. These are functional. Importance of ratios. Some ratios are important, that is primary ratios, and other ratios are secondary ratios. So according to importance, ratios can be classified as primary and secondary. Example, return on capital employed. This is the primary ratio. And operating profit margin. This is the secondary ratio. Like this, according to importance, we can classify as primary and secondary. Next one is point of time. Regarding point of time, the ratios can be classified as structural ratios and trend ratios. Structural ratios means the present data. Whatever present data is there, for that present data we are calculating the ratios, structural ratios. And trend ratios, we are calculating the ratios for a number of years, for a number of periods. That is called trend ratios. So structural ratios or trend ratios will come under point of time. Usage of ratios. According to usage of ratios, the ratios will be calculated for different parties according to different uses. Example, the creditors or the bankers will give more focus on liquidity, whereas the shareholders or the investors, they will give more importance on the profitability. So according to usage, the ratios can be classified as profitability ratios or liquidity ratios, like that. So these are the classification of ratios. Now next topic is financial ratios. Financial ratios means the ratios calculated from the financial statements. The financial statement consists of profit and loss statement and balance sheet. So from the values or figures given in profit and loss account and balance sheet, we calculate the ratios, and those ratios are called functional ratios. And functional ratios are very vital in analyzing and interpreting the financial statements. These are very important. These ratios can be classified as per the need and requirement of the users. Users requires different, perspective. So according to the need, according to the requirement, we can calculate the ratios. That is the advantage. So these ratios are not only useful for internal, but also for external. Internal means the managers. The management wants to calculate the ratios, which is for the purpose of management, internal. Similarly, some ratios are used by the outsider, like bankers, creditors, government, and suppliers, etc. They are external users. So for both internal and external users, these financial ratios are very, very important. Now, financial ratios can be broadly classified into four categories: liquidity ratios or short-term solvency ratio, capital structure ratio or long-term solvency ratio or leverage ratios. Third one, activity ratio or turnover ratio or performance ratio. Last one, profitability ratio. So for our convenience, we classify the ratio according to functions: liquidity ratio, solvency ratio, capital structure ratio, then activity ratio and profitability ratio. Now liquidity ratio or short-term solvency ratio. This ratio will be used to test the short-term liquidity position of the business. Short-term liquidity means whether the business is in a position to pay the current liabilities on time. Current liabilities are those liabilities which are payable within a period of 1 year. Within a period of 1 year. Whether the business can be able to pay the liabilities in 1 year or not, that is called liquidity ratios. Now, in other words, whether the business can be able to pay current liabilities on time. And there should be sufficient current assets, because current liabilities should be paid from current assets. So normally sufficient current assets should be there to pay the current liability. These ratios namely will make the relationship between current assets and current liability. Liquidity ratios will make the relationship between current assets and current liabilities. The following are the four types of liquidity ratio: current ratio, quick ratio, absolute liquid ratio, and basic defensive interval ratio. So in this video, I have explained you about the meaning of the term ratio. What do you mean by ratio analysis? What are the uses of this ratio analysis? What is the importance or advantage? What are the objectives of ratio analysis? What are the limitations of ratio analysis? And classification of ratio analysis. Inshallah, in the next video, again I'll explain the complete theory and formulae regarding all the four types of ratios. Then after completing that, then I'll go for the problems on ratio analysis. So don't underestimate the theory. If you watch the theory twice, thrice, four times, then only you can be able to understand the problems on ratio analysis. Otherwise, every problem will be difficult for you. Inshallah, we'll continue the theory on ratio analysis in the next video.